Believe it or not, you don't need to be a finance bro with a ton of money to trade options. In this video, we'll show you some of the strategies that can help you trade options with a small budget. First things first, strategy is the name of the game in options trading. Some strategies require a lot of cash up front. Since the risk isn't just high, it can be unlimited. So what's the alternative? Well, define your risk. That means choosing strategies where you know how much you could lose before you place the trade. Here are some examples of risk-defined trades. You have buying calls, buying puts, buying spreads like bull call spreads, and selling spreads like bear call spreads. Buying options can be one of the easiest ways to help define your risk because the most you can lose is the money you put in. At least that's the case for index options, which are almost always settled in cash. So let's focus on them for now. If you want to trade credit spreads, the maximum amount of money you can lose is the width, or difference between your strike price minus the premium you receive. For example, if you sell a $100 put and buy a $95 put, that's a width of $5. This makes your maximum risk $500 with the standard option multiplier of 100 minus the premium you collected, of course. Traders on a budget should remember the 2% rule. Never put more than 2% of your total portfolio value at risk in a given trade. A second tip is to choose your underlying stocks wisely. Yes, it can be tempting to chase trends and hyped up stocks, but lower price stocks often have higher potential for large percentage moves. For example, a $500 stock rising $10, that's a 2% gain. But a $50 stock rising $10, that's a 20% gain. A third factor to consider is implied volatility, or how much a stock is expected to move. A higher implied volatility generally means more expensive premiums, and that's not necessarily a bad thing. For example, you could pocket more income from selling options, just expect a higher bill when buying options. Lastly, let's talk time value. Option prices have intrinsic value, that's what the option is worth now, and extrinsic value, mainly time and volatility. They tend to be pricier the more time there is until they expire, since there's more time for the stock to move. And they tend to get cheaper as expiration draws near. Great for option sellers, not so much for buyers. So pick strike prices and an expiration date that you think gives you enough time to be right on your trade, and don't overpay for time you don't need. And that's a wrap. If you want to learn the ropes without losing real money, open a practice account on TD Active Trader. Plus, check out the link in the description for more info about trading options with TD Direct Investing.